Welcome to Markets Now. I'm Michelle Rook along with Shawn Hackett with Hackett Financial Advisors. Well, livestock futures after some two-sided trade ending a little bit higher in most cases, while the grain futures ending mostly lower. And Shawn, funds have been pretty relentless sellers here. We've had a lot of risk aversion in the market. What gets the funds to change their tune?
I really think in terms of the big picture, in terms of risk assets, the Federal Reserve, Chairman Powell needs to say he's done raising rates. He's done, quantitative tightening. The whole monetary tightening cycle is over. He needs to be very clear. Until he says that, I just don't think speculators are going to be in a mood to come in and buy risk assets at this point.
And corn and soybeans have also been under pressure here because we're not competitive, and Brazil's prices have just sunk, haven't they?
Huge soybean crop that's now reaching fruition, and even though we know the market needs all that supply at some point, we just don't need it all today, and they don't have enough storage, and they're trying to sell it to anybody who will buy it. It's just not a good situation in the short run, and we lose business because of it. And so far, even though the safrinha corn crop was planted a little late, very good moisture has come in, more on the way. It could be another record-setting crop for Brazil in corn. Even though that supply is not available today, it will be before too long, and the market has to price it in. I don't think it has yet.
Yeah, and we're going to be facing that big Brazilian crop for a while here. Soybeans, is that the reason that soybean meal has lost so much value, and how much lower do you think the meal market's going to go here? Because I think these are 4-month lows today.
Yeah, I mean, you have to remember that the meal feed demand globally and in the U.S. is not going to be very good. We have animal numbers that are down. We have African swine fever in China, and now we have a glut of beans that crushers can buy extremely cheap and increase their crush for meal and oil. So all this feeds into the idea that the soybean complex, has to continue to go lower until we find where we can clear out this Brazilian oversupply.
And the corn market taking out some more support areas. The March lows, which held yesterday, got taken out here today. So how much lower do you project us in the corn market?
Well, the market tends to like round numbers. If you look at a continuous December chart for corn, $5 has always been a very important level to the upside and to the downside. Incidentally, in 2012, which is one of our favored price analog years, $5 was the actual tick low in mid-May before we had the turnaround into the summer growing problems that we had that year. So I'd be keying on that 5.25 level as a place where maybe some feed producers or some livestock producers can lock in some feed.
Yeah, because as far as new crop, this market is not concerned about us not getting planted up in the north, and really thinks that the yields are going to make up for those losses in the north here in the eastern and central corn belt, right?
Well, if we learned anything about the last couple of years, you can have all the drought you want out west and up north and up down south. But if the central eastern grain belt is good, you can override a lot of that. And right now, with good subsoil moisture, the market is definitely saying right now we are not worried about those issues up in the north.
Wheat market has also been under pressure here with these rains that came in here overnight in parts of each W area and more in the forecast. So the market mentality is just what, rain makes grain?
Absolutely. Despite anyone that says it's too late, it's too gone, it's too much damage, they're still going to trade rain makes grain until somebody gets out in the field and says, you know what, it didn't really help. That quality wheat board comes out in mid-May. I believe they do a really high quality crop tour. We'd be eyeing their results and maybe give some signs that the market overplayed this rain event and how much it actually means to increasing crop production.
And spring wheat down as well because, 22-year highs in terms of acreage up in Canada, reported by Stats Canada today. Was that the main factor?
Yeah, big number. And even though they're getting off to a slow start, warm weather is expected to come in. And even if not all the acres get planted, Michelle, we have great moisture in many areas. So the concept would be big yields would overcome some prevent plant acres. And the net result is much increased production. At least that's the way it's looking now.
And SRW wheat, I think we're at 22-year lows, not 22-month lows. Yet the funds are like record short there. And what is it going to take to turn that market off of these lows?
So SRW is keying off of Matif European wheat prices, which are keying off Russian undercutting the market with their excessive selling because of last year's 105 million metric ton crop. We need to see Russia back off, and if they do, then the SRW market, I think, will see some short covering. And I think we're actually pretty close to that, but obviously the devil's in when it actually shows up in the marketplace.
So let me ask you about this Russian grain deal. Is that, or the Black Sea grain deal, is Russia the wild card here? Could they stop exports out of there on May 18th and escalate this war and maybe turn this thing?
Certainly anything that says that supplies out of Russia, Ukraine might slow down and that they might be done with that, making all this cheap wheat available to China and the Middle East would certainly be a call to action. Like you said, heavy record short positions as a percentage of open interest means there's an itchy trigger finger to buy back on any signs that the shorts have outlived their stay here. I think that's something to look out for.
Gotcha. So you talked about risk aversion and the Fed and their posture here at the top of our broadcast. So I guess talk a little bit about, we have a lot of economic data coming at us this week, first quarter GDP, PCE. Will that give the Fed, you think, enough ammunition to raise rates? Because that's kind of what we're seeing as a sentiment in the market.
I think the sentiment is 85% chance the Fed's going to raise a quarter point next week. The PCE would really have to blow out downside expectations for them to pause, given what they've already said. But the bigger picture is the regional banks continue to see massive deposits coming out. They can't go on that forever. The Fed has to come in and try to save that at some point. So the key will be not if they raise next week, I think they're going to, but what will they actually say that that's it, we're done, and we're watching the banking sector for signs that we might need to turn tail and pivot. We've got to see that for risk assets to catch a bid here.
So could the debt ceiling discussion, if this goes out to the 11th hour, could that also maybe weigh on the risk aversion or add to the risk aversion we're seeing?
Well, certainly, we've been through this before, Michelle. It's not the first time we've had a debt ceiling crisis, and we always do seem to solve it at the last minute, but we also haven't had this kind of debt levels as a percentage of GDP before. And when the market's already nervous about a lot of other factors, I just think people are going to say, you know what, I can always come in and buy it if they solve it, but just in case they don't, I'm going to keep my powder dry. I think that's something that they're not going to want to buy ahead of.
All right. Well, a lot of moving parts there. Thanks so much for your analysis. Shawn Hackett with Hackett Financial Advisors. And that's Markets Now.